Hello and welcome. Thank you for joining us. We're talking about Zim again, and hopefully for the last time. Not that Zim is bad. We don't have anything against Zim, but there are some questions that you guys had that we felt we needed to answer.
There's a lot of red flags with Zim when we looked at them about a year ago. We had 2 different month purchases for our stocks where Zim was listed in there. You don't have to go back and look at those videos. We were learning YouTube. We'll spare you the pain. So at the time, there was a lot of red flags, and we want to look at what happened with Zim from that initial point of review all the way to our first video on Zim and where Zim is at today and potentially when Zim might look like a good purchase, because we're not hating on Zim. We just like to look at the numbers. So we'll show you all that, and we'll show you what would have happened had you purchased Zim when it first came across our desk.
So some of the questions that we had that I wanted to answer was, a lot of people were just dollar cost averaging down because, okay, I bought it at 60, but I'm just going to dollar cost average down over the next couple of years and collect the dividends off that, and I'll make up my money in the dividends. So I wanted to show exactly what happens when you actually do that. I created a spreadsheet I picked a couple different values. One was $90, so that was at its peak. If you're a bag holder, I'm sorry for you that you are holding that stock. But
yeah, when we first looked at Zim, it was trading over $80 a share. So by the time we did our first video, it had gone from 80 to 25.
Right.
So
I just wanted to take the very peak. If you were one of the very unlucky people to get in at that point, and you dollar cost averaged and dripped those dividends back into the stock, how much it would be worth today and how much you lost. I also did a version of if you just kept the dividends and didn't drip it back in.
And we have that spreadsheet right here.
I also did it for $40. So you waited and got in at $40 instead of the 90 on its way down, and these would be the dividends that you would have gotten for that. So if you look at my little spreadsheet, and I'll make a little chart hopefully, if you would have gotten in at $90 and you put $10,000 into it, you would have gotten 111 shares out of that, roughly. So you could see the different dividends, how much you would have gotten from that, how much stock you would have gotten. So from then till now, which would have been about the March 22 time frame to now, you would have got roughly 62 to 63 shares with the drip, which is good. I mean, you got extra shares. You didn't do anything for that other than hold stock. But the problem is, from the $90 price point down to what it was now, $18.75, the valuation went down to $3,258. So you went from $10,000 to $3,200, which was bad. You got about $1,700.25 in total dividend value, but you've lost 67% of your valuation just on holding the stock and dripping into it.
And you could counteract that and say, oh, but I'm dollar cost averaging, I'm going to be buying at this point, and I still have those shares and the value will go back up. We'll get to that. There's methods to determine when a stock is a buy. We're going to apply some of those to the stock at the most rudimentary basic level without making this a 50-minute video. It's very difficult to do it in a non-podcast form. We're working on that. But for the sake of purpose of this video, I thought it was really interesting when you go through the spreadsheet where if you had drip funded the dividend checks back into the stock, you get the extra shares, but the value was actually greater if you took the dividends and you didn't drip them than if you hadn't.
Right. I
think it was, what was it, like $300, something like that? Yeah, right here.
$32.58 to $35.89. So you'd have gotten $1,500 in dividend checks, but you, instead of put that in, that valuation didn't go down.
What's going on with the shipping industry? It's on fire. I mean,
all shipping industries.
All shipping industries.
Doesn't matter which shipping, if it's Zim or Costco or any shipping, they're all on fire.
TEU rates, the devaluation of the dollar as a global trade currency, the PMI index, so manufacturing, how that's decreasing, the fact that the Fed actually has finally admitted that we're going to go into a mild recession. They think that's coming this fall, but that's all affecting the demand for shipping. Shipping, however, is cyclical. So this stuff that's looking apocalyptic now, got to mention the apocalypse at least once.
Always.
So that's cyclical. It'll come back. It's going to take some time. But if you want to find out how Zim is doing in relationship to its peers, you can look at Costco, and that's not like Costco, the retailer. It's COSCO, stock ticker symbol here. And there's a few other companies in the space that do that. Most of these companies, however, are pink slip stocks. So you got to trade them on the OTCBB, or you got to have a different type of account rather than a standard like E-Trade or TD Ameritrade account. So to find out what's actually going on, you have to look at what Zim is reporting to their financials. And remember, Zim is they're not the only one dealing with this. If you looked at Costco, which is the one based out of Beijing, their finances are decreasing by almost the same metrics. So
right.
the TEU rates and the shipping container rates is usually who can bid at the lowest. And in this case, they're one of the big players. So you can see that what affected Zim here financially affected them too. So the current container prices right now are depressed. They're still looking to be depressed for the next 2 years. You can look at the relationship here. We'll have some kind of photo up here so Maybe. You can see that, hopefully. As far as Zim goes, though, tell me a little bit about Brian has been digging into this for us, and he's been looking at their finances. Finances?
Finances.
I
like it.
Look at the finances. But he's been looking at what's actually happening to this company. And when we first looked at them last year, they were running around 2.2 billion. I think right now they're 2.1?
2.1 billion.
2.1 billion. And then they're going to, they said they were going to decrease quite a bit.
Right. And that has a lot to do with the economy right now, and the world economy. There's not as much being shipped. There isn't the buying and manufacturing that there used to be. And it's pretty bad. So one thing that Zim's doing that is on the good side is they're looking at different routes, so shipping lanes to go to different areas. So the Asia Pacific shipping lanes, they're doing more with the east side of the U.S. for like the L.A. and whatever the other port that was there. They are functioning a lot better with our issues with unemployment and and not having people to actually take stuff off the ships. They have a new form of car carrier that they are trying to get into, so shipping cars instead of containers to get different types of monetization out of their company. So they are doing some good things that will help them in the future, and it makes them look a lot better than just being destroyed by TEU container costs.
Freight rates, right. They said, Brian shared with me these reports, they were going from 2.1 billion down to like 1.6, and that's their projected net revenue. Now, Zim has been a company that said that we're going to pay 30% of our net revenue in dividends. Well, their net revenue is projected to be negative. So that dividend check that everybody was counting on, probably not going to happen, at least in the near term.
Right. There might be a very small one in 2023, but don't count on it for 24, maybe 25.
Yeah, and you can find all these finances too if you just pull up the report. Thankfully, Zim is one of the publicly traded New York Stock Exchange stocks, so you can actually see the finances. Any of the other ones, especially like Costco, you have to go into it, and you're getting delayed reports. You're not getting the current stuff, and if you do get it, it's going to be probably a quarter behind. The most recent one we could find on Costco was back from last June, so that didn't exactly have current, like if you're going to compare Zim to Costco, you're not going to have the exact numbers for the month to date.
Right. There's two things here. The problem with Zim and how they report their chartered ships and how it's either an asset or a liability. If you go into Fidelity or TD Ameritrade or any of these and you go into the financial statements there, It's not very well defined where that is actually on their financial statements. So, like Tom says, you have to go into their SEC financial statements and download the PDF and go through that to actually find it. Which it's kind of weird because Zim doesn't seem to show them as a liability. They're just an asset.
It shows up in their payments. So you can see their outgoing liabilities per month in their statement. It doesn't, you would think it would show up in cost of operational revenue, but it doesn't. It just shows up as a liability payment. And the biggest problem I have with it is people are going to say, well, Tom, when would you buy Zim? It's a long discussion, and I don't want to nerd rage on everybody. So Zim will be a good buy eventually. And we're probably going to be looking at them this fall. There's a few things that we want to see. And the first question I would ask you is somebody's looking at, well, why should I buy Zim? The liability statement that Brian just mentioned plays a good part to this, that you want to see the financial numbers looking good. And right now they don't look so good. Here's a big indication of that, is that because their ships are leased, well, they're leased at a certain rate. Those leases are on a 3-year term. That 3-year term is going to be coming up relatively soon. So if the Fed rates and the central currency for the dollar is way up here and their lease rates currently are way down here, all of this TEU rates where the shipping containers prices go up, and that's good for Zim, is going to get gobbled up by the fact that the leases on their current ships are going to be much more expensive. So when is it a good time to buy? We want to really see their operational revenue turn the other corner, not go from 2.1 billion down to 1.6. We really want to see it go from, maybe if it does go that far, we really want to see it go from like maybe 1.6 to at least positive, maybe 1.7, 1.8, and then we really want to see what happens with not just the TEU rates, but all of these leased liabilities. It's very different if the company owns these assets, but Zim does not. Yes, we know that makes them more nimble. We know that. But it also poses a risk because of those payments. So keep that in mind. If I were to buy Zim, I would not buy them as a dividend stock. I would buy them as a growth stock because so much of their dividend is based on the principal book value times their earnings per share rate. I mean, it's based on how much cash flow they have too heavily.
Right.
Their operating revenue can't cover it long term. Short term, yeah, Tom. Well, Tom, they got all this cash. Well, yeah, they did for a while. They went public and they got a lot of cash. Not all of it came from going public, but a good chunk of it came from going public. So that cash flow can cover it for the short term. But when you buy a stock, my question to you is, if somebody says, I want to buy Zim, is what is your end goal? Because if you hold a stock for short term, we've covered this in the past video, you pay higher taxes, there's a tariff 25% because it's a foreign company. There's things that go into play. So if you want to buy it for growth, you have to hit a certain level of stock price appreciation to see that as an actual profit. When we buy stocks for principal appreciation secondary to income generation and the ability to protect our principal.
Right.
We don't want to lose. We don't want to go from $10,000 to $3,500.
I don't like losing money. I like gaining money.
Right. So Zim will probably be a good buy when the TEU rates come back. We know what's going to happen with their lease agreements with these ships, and we also know that we can see some operating revenue reports. So look towards them this fall. And then the one thing that you really want to pay attention to is the manufacturing index, the PMI index. So when you can see manufacturing pick up and orders pick up, shipping will follow that. But we're going into a recession right now, so that's not really the case. Is there a price target? Technically, there is. But
you want to buy as low, right? Buy low, sell high is what you want to do, but
it's inaccurate for a company this small and for what they do.
Right. And they are depressed. I mean, they're 17. I think they IPO'd at 17, so they're kind of where they're at in the beginning.
Right.
Will they go up? I think they're going to go down a little bit to maybe 14.
They have a book value of somewhere around just above 8. And when you look at the standards earning per share rate for the industry, it's sometimes around 4 times earnings. So 4 times earnings times the book value brings you somewhere around $38 a share that Zim should be at. Well, Tom, are you saying Zim is going to be $38 a share? No,
it's undervalued buy.
Yeah, I'm not saying that. I'm saying there's a whole bunch of things that go into it that We're probably going to have to podcast at some point because I can't condense it into a 30-second little blurb. So you have to look at the other companies in an industry, the PMI index, all the things we just mentioned to understand where the price should go. But we're going to wait until we see those numbers.
Right.
We're long-term investors. Short-term investors, you could probably buy it. And we believe that the PMI index and the recession will probably turn a corner sometime around late 2025, and the things will start looking positive again in 2026, and then probably 2027. That's what all the government offices are saying too. They're saying that, hey, we think that things will start recovering finally by 2026.
Yeah.
That's a long time from now. It's
Well,
2023.
I really see Zim as a long-term hold, personally. I see it's you buy it and you keep it for 10, 20 years. I don't see this as a try and get in a short position or do covered calls or something on them. It's more of a long play, keep putting into it. So the people who did buy at 90, they might eventually be okay if you're going to keep it for 10 to 20 years. One thing I hate is being locked into a stock that I can't sell because I'm going to sell it at a loss and having to keep dollar cost averaging that over a year. Because if I want that money or need it for something, I can't. It's stuck. And I'm just waiting for Zim or whoever it is to make money so that I can get out of that position.
And people do crazy things with stocks when the valuation does that, when it drops that much. So you might be holding on to it for a really long time. When we buy stocks, we actually purchased more of the 3M stock that we had for month 13. We double dipped into it. When we purchase stocks,
Snuck that right in.
Yes, I did.
13 purchase.
13th purchase. We'll get into that. But we buy for long-term reasons to protect your principal. Zim is a company that's in an industry that is based on the lowest bidder, and it's very cyclical. So if you're new to investing, I would avoid sectors that are that volatile.
That would not be my first choice in my first stock. You go with something safer to get your portfolio built up, and then you might be able to dabble into the Zims.
Yep, and last year at $80 a share, nope. Too many red flags. Even when we recovered Zim, 25, when they were talking this huge dividend, nope, too many red flags. Now those red flags are less because we actually have a little bit more clarity around the visibility. So if you're very experienced and you want to dump some money into it, wait until you see the finances, the PMI index and TEU rates recover, and then you might be able to buy it as a growth stock, not as a dividend stock, because the dividend's too inconsistent.
Right. The dividends I see as a bonus. It's like getting a bonus at work. You weren't counting on it, but hey, it's a bonus.
Yep. So back to 3M.
All right. So what did we buy?
We bought 3M stock this month. We have the spreadsheet that we go through, and we look at the companies that are performing the best in our portfolio, which beat the Standards & Poor yield, SPY, by like 16% last year. So good for us. Yay. Wave a little flag.
Hopefully next year we can do the same. No guarantees.
No guarantee. Disclaimer. We don't always suck, but when we do, we disclaimer it.
Yeah, we do.
So the 3M stock was one of our worst performers up until recently, and these things fluctuate. So we took the one that was the worst performer, our 3 worst performers, we put them on a spreadsheet and said, all right, let's look at their finances. Why are we doing this with 3M and not Zim? Well, 3M tends to make products that people have to have. It's like buying Colgate stock. If people stop brushing their teeth, that would be a really bad world. The point is that 3M produces products that people have to have. They also have a very defensive moat. They have a pretty cornered market on a lot of the products that they make. Right. So when their stock is depressed, especially the last 5 or 6 years, they went way up and they went way down. And the whole time, their earnings just kept getting better and better. And yeah, we know there's a lawsuit, but that doesn't affect their earnings too terribly, at least not yet. But over the course of the last, 50 or 60 years, they've increased their dividend almost every single year.
Right.
So this company is, comparative to Zim, very low risk as far as what's going to happen to your principal, especially when you look at where they were in 2013, where they are now, the amount of dividend that they pay. And in our current portfolio, we bought them and they dropped like 7 or 8%. So we said, okay, they're one of our worst performers right now, but of all of our worst performers, their finances looked the best. Their cash flow was still good. Their operating revenue went up. Their finances looked okay. Their earnings per share were better than expected. They just posted a report where they showed that. So, okay, we'll jump in. Does that mean we're going to do it again next month? Probably not.
Probably not. We're going to keep looking at the different stocks that we own, and we're still looking at real estate and different sectors.
I'm almost there. Not quite yet. I'm almost there. We bought 3M for that reason. It's the worst performing one in our current portfolio, and it is of the worst ones. It looked the best financially. We almost doubled down on Devon. We didn't because Devon still shows some risk there, and this minds the point all the way back to the beginning of this video. Mind the red flags. When we saw the red flags last year, we waited, we avoided it, and that prevented us, if it was $10,000, from losing like 68% of your investment.
Right.
So,
and then you're stuck.
Mind the red flags. So we pay attention to that, and then we don't invest in the companies that have these red flags, at least temporarily. We're not hating on Zim. They're actually, on a positive note, they're one of the few companies in shipping and freight that you can actually trade on the stock exchange.
Yeah, when I was looking for competitors, Zim's actually up to the 10th now on the list. I think they're 15th so they're getting up there. When I looked at the top 10, only like 2 of them you could actually trade on the stock exchange and not an over-the-counter type.
Makes it easy to see their financials, so they're regulated. So that's a positive thing.
Yeah.
So at some point, Zim will be a great buy, but last year was not the case. There's a lot of red flags. This year, there's still a few, but there are so many less than there were. There's so many less. So not yet, soon. Again, we bought 3M stock this month. We're trying to look at cyclical products next month, but mind the red flags, people. Pay attention to what a stock is doing that doesn't look quite right. If it sounds too good to be true, it probably is. This is why. This is why we go through the stocks the way we do. This is why we purchase the way we do. And as far as our personal portfolio goes, I think we're up to $20 a month now.
Something like that, yeah.
I think we've gotten over $20 a month now. So after 1 year of stock purchases, we've got a passive income of about $20 a month. And we've beat the Standard & Poor's by quite a bit. And that index dropped 13% last year. We've appreciated our principal. So we've actually made money on our investments. It's not a stellar amount. It's not like, we bought 15,000% this year. We went up that much. It's not like that. It's a small amount. But our cost basis is low, and now we have passive income. We didn't have that this time last year, and we also didn't really know how to talk in front of a camera last year.
Right. Editing, any production value, no.
It wasn't there.
It's still not great, but we're learning.
We're learning, so thank you for sticking with us. We appreciate you guys, especially for all the comments that we've got, and we're hoping this helps. We might have to record again on some of the financials and put some overlays on there for you just so you can see some of those numbers. But hopefully you found this valuable. If you did, subscribe, like, and look for us for our month 14 stock purchase. And we're going to be changing our video format a little bit. I go on these nerd rants with Brian about these stocks that we're going to purchase. We do some analysis on them, and we're a lot more fluid in those. So I think we're better at podcasting than we are trying to condense all of that nerd rage into like a 10-minute video. It's really hard to do that. Yeah. We're still doing our monthly stock purchase. We're going to do a live stream, and then we're probably going to get into some financial advice per month on just how to get out of college without a whole lot of debt, or how to get the best rate on a home mortgage, or what to do with your cars.
Or how to not spend more than what you make.
It's pretty hard to do when you don't make a lot, but
it is.
It's sort of doable in today's
It takes a lot
market.
of discipline.
Yeah. Yes, it does.
If you've gotten this far in the video, thank you so much. Go ahead and put red flag into the comments so that we know you got here. And we'll see you next time. As always, happy streaming.
Streaming?
Sorry.
Happy streaming.
And as always, you guys say it with me. As always, happy investing.
He said streaming.